what I'm going to do today is give you $7 targets, 7 end game dollar figure targets for the silver price, ranging all the way from $118 all the way up to $3,002.
I am preaching that right and left these days, that these silver stocks, they've moved a good bit, but these junior silver stocks are the most explosive area I see going forward. You know, we had a little run in the spring of 2016, and across the board, they all quadrupled and quintupled over 6 months. They can move and will move. And, you know, again, silver's popped over $40 today on a spot.
2025 has been nothing short of historic for precious metals. All year, investors have been rushing into gold, looking for safety as stock markets stumble and the dollar sinks. But here's the twist. Most people didn't see coming. Gold isn't the star of the show. Silver is. For the first time in 14 years, silver has smashed through the $40 barrier, hitting $40.57 per ounce this September. That's a jaw-dropping 45% gain in less than a year, and it's just the beginning. Why does this matter? Because silver's market is tiny compared to gold. The global silver market is only worth about $25 billion, while gold towers at over $180 billion. That means even a modest move of capital, say $1 billion shifting into silver, represents around 4% of its entire annual supply. That kind of pressure can send prices soaring. And according to silver specialist Rafi Farber, the current price is a complete illusion. He says silver's true floor is over $100 per ounce, even on the most conservative metrics. If silver returns to the same ratio it had against the S&P 500 during the 1980 monetary panic, the price doesn't just double or triple, it explodes to nearly $3,000 per ounce. That's not hype. That's how markets behave in a full-blown panic. Stocks and paper assets collapse under their own weight, while real, tangible money like silver gets revalued almost overnight. And history is on its side. Over the last 20 years, silver has posted positive gains about 65% of the time between September and November, consistently outpacing the summer months. In other words, this is silver's season to shine. So buckle up. Because as Rafi Farber and Brian London explain in their latest interview, what we're seeing now is only the opening act. Before we dive in, make sure you hit subscribe and tap the bell icon so you're the first to know when the truth breaks through the noise. Let's get started.
Money itself. So the answer is that all the silver now accessible by people above ground will be exchangeable for all of the wealth on the planet. What that dollar figure exchange rate is could be anywhere from $118 to $3,002 based on today's monetary metrics, which change daily. But let's get into it. The 7 targets for the silver price, starting with the CRB adjusted ounce target of $118. CRB adjusted means we're going to take the silver ratio to the CRB commodity index, its lows, meaning how many ounces of silver did it cost to buy one basket of CRB commodities. The CRB commodity index is an index that's been around since the 1970s, I believe, or even earlier. I think it was interpolated earlier, but it started to get use in the 70s. The low for this ratio means the least amount of silver ounces that a CRB commodity basket was worth was, of course, in 1980 at about 8 ounces. Well, you see here where it says last 20.22. So if we go down to 7 or 8 and then we multiply that factor by the current silver price of $41, we get $118 per ounce of silver. But this is the lowest dollar amount. CPI adjusted ounce target. If you adjust for CPI, a lot of people are fans of this one. I'm not a particularly big fan of this ratio because the CPI itself is adjusted and manipulated and doesn't make much sense and is very subjective because people buy different things. But anyway, the high here for 1980 relative to the CPI going back to 1800, or interpolated back then, which is all an estimate because nobody knows exactly what the prices really were back then. But anyway, the high was $172.54 CPI adjusted silver ounces in 1980. But that target I don't really like, and I don't think it's realistic. I think it's way too low. The Dow Jones Industrial Adjusted Ounce 2011 target for silver. So we're going to take the Dow Jones ratio to silver back at the 2011 high. This is not the 1980 high. That's a separate chart. We're going to get to that in a minute. The 2011 high was at about 250 ounces of silver for one Dow Jones Industrial unit. And we are at 1146. You can see here, this is the first bubble of stocks, major bubble relative to silver, peaked in 2001. This is the second bubble. It's been wobbly since about 2017 or 2018 top over here. And we've been heading down since then in jagged little edges, but I think this bubble has peaked in 2017 or 2018, whenever that peak happened to be. If you take the 2011 top in silver ounces, 250 ounces per Dow Jones Industrial Average unit, 1146 to 250, take that ratio, multiply it by 41, and you get a target of $188 for the 2011 silver high relative to the Dow Jones. This is much more realistic. Now, if we reach the 15-to-1 gold to silver ratio, which we will at the current gold price of about $35.50 over the weekend, that leads us to about a $236 target for silver if the gold dollar ratio doesn't move, which of course it will. Anyway, here again is bubble 1 of stocks relative to silver. Here is bubble 2. And so if we take the 2011 top at 25 ounces of silver per S&P 500 unit, we are at 162 now. We were at 25 then. Take that ratio, multiply it by 41, and you get $265 an ounce of silver if we reach the 2011 highs relative to the S&P 500. But let's go further still, and now here's where we take a quantum leap. The Dow Jones Industrial Adjusted Ounce 1980 target of $2,676 an ounce. Why is that? Well, if we look at the silver to Dow Jones Industrial ratio, remember the chart a few slides ago where we took the 2011 top. Now we're going to take the 1980 top. We're going to reverse the chart so we can see it better. The top of silver relative to the Dow Jones Industrial ratio was 57. This, of course, is the ratio times 1,000, just to give it better, easier to do math numbers with. So if you take the ratio, multiply it by 1,000, we are at 0.873 now. We were at a high of 57 back in 1980. So if you take 57 divided by 0.873 multiplied by the current silver price of $41, you get a target of $2,676. Now let's move to the final target for silver. This is the S&P adjusted ounce 1980 target is $3,006. How is that? Because the ratio of silver to the S&P 500 index is now 0.006. You can see we've had an amazing rally in 2025. You can see a tiny little bump up. Look at that. It's amazing. What a rally. Silver is really tearing people's faces off. Is that the expression? Not really. Not yet, but it will. But if we take this number and the peak here is at about 0.43, that's where the red line shows, maybe 0.44. I think it was actually 0.44. So if we take 0.44 divided by 0.006, multiply it by the current silver price of $41, we get $3,006 per ounce of silver. Now you could ask me, why do the silver to stocks ratios jump up so dramatically relative to all the other ratios? What is the deal here? I would say that 1980 was a true monetary panic, and in monetary panics, the top derivative layers of the pyramid fall the fastest, and all the purchasing power from those layers of the pyramid gets destroyed the fastest. If you have something like the CRB index, which is a collection of real commodities, or the gold to silver ratio, which gold will only go down to about 15 to 1. The Dow Jones and the S&P 500 by comparison are a measure of derivatives, things that are not money, that are farther away from money than, say, commodities are. And the CPI, for example, is the consumer price index, how much it costs to buy real commodities. And so those things are not going to fall in value because you need them relative to stocks, which you don't because they're just derivatives. And when derivatives fall because credit falls, their purchasing value goes down the fastest. So this time, I think we're going to get closer to the $3,000 targets that we saw hit in 1980 in the Dow Jones and the S&P 500, because it is the top derivative layers of the pyramid that will fall in purchasing power the fastest.
According to financial advisor Brian London, today's buyers aren't Wall Street speculators. They're central banks, and that changes everything. With central banks soaking up gold, silver, and mining stocks have been left trailing behind. But London sees this not as a weakness, but as a once-in-a-generation opportunity. A lot of people think the gold bull market is almost over. London disagrees. He believes we're only about halfway through the cycle. The first half was led by central banks, but the second half will be powered by speculative investors chasing leverage. And that's where silver and the miners come in. Silver miners are already using 2025's breakout prices to expand production and snap up new projects. Analysts are calling it the sector's biggest growth cycle in more than a decade. In fact, the Silver Institute expects 2025 mine output to hit a 7-year high, with prices averaging 44% higher than the past decade's levels. Looking ahead, the silver mining industry is projected to grow to $42.2 billion by 2032, expanding at nearly 9% per year. And right now, gold and silver miners are already outperforming the broader market. The real question is this the beginning of a true safe haven supercycle, or are we looking at an overheated rally? History suggests the upside is still massive. In the last gold bull market, gold rose 7.6 times, while junior mining stocks delivered gains of 10 to 20 times. This time, London says gold could reach $8,000 an ounce, driven by de-dollarization and the global rush to hard assets. If that happens, the leverage in silver and junior miners could be life-changing. Let's get back to the interview.
In every bull market, every long-standing bull market of gold, silver has outperformed gold. In my analysis, it's going to do that again because it always has, very simply put.
Yeah.
Keep it simple, stupid. It should do that again. There's no sure thing. We're just playing probabilities, and that's a pretty high probability. But the new truism is that gold and silver lag gold. But miners in silver lag gold. But in the 1990s and 2000s, it was the reverse. It was an accepted wisdom that the miners usually preceded gold on these, especially in these intermediate rallies, because investors saw that coming up and the smart money went into the miners because they expected gold to rise, and were often correct. And not saying there weren't some false moves and false indications in the miners as well, but right now, because the central banks are leading the whole gold story, and it really isn't accepted wisdom that you need to be in gold on Wall Street yet, it's being dragged along. The smart money in Wall Street are trying to react instead of be proactive. So they are being pulled along and now trying to find some way to play this trend, and seeing that gold's gone up so much. The laggards are the way to play it now. And those laggards are the mining stocks and silver, because that's not what central banks buy or have been buying. If I look at the gold price and say that we're about halfway there for where this cycle will take us, and I'm saying, fourth inning, something like that.
Yeah.
Fifth inning. I would say that, but it's the biggest moves, come toward the end. I don't know what it's going to take to get the speculative FOMO investors to buy gold at these prices. The trend will have to continue.
Yeah.
But I think they're going to go into it looking at leverage and looking at mining stocks and silver. And, silver leverages gold, but you can get silver stocks that leverage silver, so you can stack your leverage. And I am preaching that right and left these days, that these silver stocks, they've moved a good bit, but these junior silver stocks are the most explosive area I see going forward. We had a little run in the spring of 2016, and across the board, they all quadrupled and quintupled
Really?
over 6 months. They can move and will move. And, again, silver's popped over $40 today on the spot. In the long history of gold bull markets, which for a 4,000-year-old asset stretches back only to 1971. But over that period, we've had 3 previous bull markets by my count, and this is the 4th. But this one's unique, primarily because, really for that very reason, we've had no real corrections other than the one right after the presidential election in the US. Other than that, the corrections have not been of the depth or duration that classic technical analysis would have predicted.
Right.
And my thought is that that's because what's been really driving this bull market has not been the ebb and flow of investor emotions that you see in a typical investment or typical asset, but rather the programmatic buying of central banks who really aren't subject to those, bouts of euphoria and despair that typically drive markets. So the corrections, instead of being steep declines and hitting support levels on the bottom, have just been really pauses in the ascent. Now, that said, this pause has gone on a bit longer than we've seen before, but it's typical seasonality. In a bull market, the average bottom for the gold price in a bull market is any time from mid-July to mid-August. So, that if you look at the charts with and really narrow in, that may have actually held this time. But I think what we're seeing now is not only the summer doldrums relenting, but also really a fundamental shift in sentiment for risk assets, because I look at what Powell did at Jackson Hole as just essentially unleashing the hounds and returning to an easy money environment. And that environment will be very bullish for the monetary metals, gold and silver. I think it's going to be bullish over the short term for all risk assets. But, the stock market is so toppy right now and overvalued that anything can happen there. I think gold and silver are the real beneficiaries here. In the 2000s, the junior mining market was extraordinary in that first off, you had a rising tide was lifting all boats. So instead of your loser in the junior miners losing 50% or more, it might be staying even and might be only going up 50%. And your winners were going up 3, 4x, being taken over, or you would sell, roll it over into another one that would go 4 or 5x. Then every now and then you would have a 10x. Every now and then you'd have a 20x in your portfolio. The most extraordinary rapid buildup of wealth. 2000 to 2011 with a short, hiatus in 2007. Or 2008 rather. But it was an extraordinary period to be in the sector. I think we're looking at those kinds of returns again, because we've had, I count the 70s as 2 bull markets, early 70s and late 70s. There was about a 1-year bear market, 75 to 76. And that was pretty severe. Gold went down 50%. So it was, I think, a clear bear market. So if you look at the potential for gold, you mentioned earlier that is gold topping out now? Is this as far as we're going to go? We're in uncharted territory here. So I look to the previous bull markets to get an idea of where we could go. In the early 70s, the gold price went up 5.6 times from the low to the high, trough to peak. In the late 70s, it went up 8.2 times trough to peak. In the 2000s, it went up 7.6 times from trough to peak. If you mark the low for this cycle in December of 2015, as I do, at like $1,050, that means we'll peak out at somewhere $6,000 to $8,000 range. Now, other people interpret it differently. They lump the 70s as one big homogeneous bull market. If that's the case, then you're looking at 24x from trough to peak. And at that point, you get into, are we going into a new financial monetary regime where they're going to back M2 with gold to some percentage? That's when you can get into those numbers like $20,000, $30,000 gold price. I'm not predicting that, but I'm recognizing a trend here that gold is telling us something. This gold price has risen because at least the central banks feel there's something ahead. I think that, yes, they want to protect themselves from the dollar weaponization, the U.S. hegemony. That's definitely a big part of it, probably the majority of it. But I think they're also looking at the fiscal situation in the U.S. and indeed throughout the West and developed nations where debts, after 45 years of ever easier money, the debt accumulation has risen to such a level that it's really putting a bind on, structurally on fiscal budgets and will going forward if interest rates remain at these levels.
Silver has officially taken the crown as the top-performing commodity of 2025, outpacing gold thanks to its rare dual role as both an industrial powerhouse and a true store of value. Breaking above $40 an ounce is a massive milestone. The last time we saw this level was more than a decade ago. And with gold itself pressing toward new all-time highs, the stage is set for something even bigger. If history is any guide, the largest gains always come in the final stages of a bull market. So the big question is, are we about to witness silver and the mining stocks unleash their most explosive run yet? I want to hear from you. Do you think silver still has room to run, or is the rally already stretched? Drop your thoughts in the comments below. And if you found this video valuable, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss the next update. Thanks for watching, and I'll see you in the next video.